महावीर की संतान हूँ मैं, फिर बन के शेर दहाड़ूंगा। तूने मुश्किल हालातों में भी मन में अपने धीर रखा। इन कर्मों की बदौलत ही तू वर्धमान महावीर बना। महावीर तेरी संतानों की मैंने लाख दुआएं पाई थी। जब मौत सामने थी मेरे, मैं आंख दिखाई थी। तूने कितने उपसर्ग सहे, तुझे कितनी आँचें आई थी। जब चंड कौश ने डंक किया, तूने दूध की नदी बहाई थी। हाँ मैंने अब ठाना है, वो युग वापस लाना है। अंदर का अब वीर जगाना है। जो तूने सिखलाई थी वो बातें अपनाना है। महावीर सा मुझको बन जाना है।
Jambo, jambo bwana, habari gani? Nzuri sana, wageni mwakaribishwa. Jambo, jambo bwana, habari gani? Nzuri sana, wageni mwakaribishwa. Kenya yetu hakuna matata. Ngiti jambo, jambo bwana, habari gani? Nzuri sana, wageni mwakaribishwa. Kenya yetu hakuna matata.
A good morning, good afternoon, and a very good evening. A very warm welcome to today's Zoom session, Inheritance Tax Inherently Unfair. Ladies and gentlemen, I would like to welcome you all. And before we start today's Zoom session, we would like to pay a 1-minute silence to a very big loss to the British Empire and to the world. His Royal Highness, Duke of Edinburgh, Prince Philip, lost his body yesterday. He left for the upper world, a better place, only 2 months short of 100 years. We pay respects and sincere condolences on behalf of Minla and all the Zoom participants to our Queen and the royal family. So, ladies and gentlemen, we are going to observe a minute's silence for our Prince Philip. Thank you. Thank you very much, ladies and gentlemen. We send our best wishes to our Queen and we say, rest in peace, Prince Philip. Good morning, good afternoon, and a very good evening, and a very warm welcome to all of you wonderful people from all across the globe to this wonderful session on inherent tax, inherently inheritance tax, inherently unfair. This is a 43rd consecutive Zoom session organized by Minla meaning Meena Kagram and Lalit Soda. We started doing these sessions as of April 2020 when we first got hit with our very first COVID pandemic lockdown. Meena Ben and myself, we thought we have to inspire and motivate the people all around the globe, and we took on this gigantic mission to make sure we get different kinds of speakers from all walks of life, all different fields, to actually get our mind and body stimulated. And very quickly, we found out during the pandemic, inheritance tax is something that we should all be planning on. We were truly delighted when Mr. Dipesh Shah actually took this on board and decided to dedicate his time to our Zoom session to make sure that he can give and share information voluntarily to the Zoom people, or all the guests on the Zoom session. So today, we are truly also very delighted that the Lohana Community United Kingdom has collaborated with us on this particular Zoom session. We have the chairperson for the Lohana Community United Kingdom, Mr. Sunil Bhai Majitya, the secretary, Mr. Bharat Bhai Soda, and many other members of the Lohana Community United Kingdom joining with us on this Zoom session. So without any further delay, I would like our lovely Meena Ben Kagram, who is actually hosting from Nairobi, with his absolutely co-host, Mr. Ali, hosting from Nakuru. So I would like Mrs. Meena Ben Kagram to take the floor before we start the Zoom session to move forward to actually traditionally welcome our guest speaker for the day, Mr. Dipesh Shah. Meena Ben, the floor is all yours.
Dipesh Bhai, welcome to Nakuru, Nairobi this time. Actually, we are from Nakuru. Special tilak for you and some chokha, and my husband will garland you. That's Ramesh Kagram. Thank you. Thank you very much. Global Namaskar to all. Jambo. Karibu. Good evening, ladies and gentlemen. Welcome to the flamingo town of Nairobi, not a flamingo town of Nakuru, but the capital town of Nairobi, where in Kenya, the famous and very popular person like Eliud Kipchoge is born. He is the fastest runner in the world. Dr. Lalit and he is my cute cousin, and myself, Min Lazum, are super excited to welcome you all here who have joined Zoom at moment in Zoom session and Facebook Live. Welcome Sunil Bhai and Bharat Bhai of Lohana Community United Kingdom. Our great supporter, makes you welcome Dipesh Bhai Shah. Really excited to hear your speech. Bibi and Abana. Let me introduce you, our backbone of this session, MC Dr. Lalit Soda. He is a professional speaker, chiropedic, and author of many books. He is a recipient of many awards as well, but he humbly says, don't mention. Can't help to say recently he's been awarded Marwa Journalist Award. Over to you, Lalit.
Thank you, Minaben. Thank you very much for those very kind words. And now we move the Zoom session forward to our president of the Lohana Community, United Kingdom, Mr. Sunilbhai Majitia. I would request you to formally welcome the guest speaker, Mr. Dipesh Shah. Welcome on board, Sunilbhai. Sunilbhai currently is the president of the Lohana Community, United Kingdom, and he's a very hardworking gentleman working towards all betterment of the Lohana community all over the United Kingdom and internationally, dedicating his time and efforts through himself and his family to make sure that the community gets the best. Sunilbhai, it's all yours.
Hello, everyone. Thank you, Lalitbhai, for those kind words. Before I start, I would, on behalf of LCUK, the Executive Committee and the trustees, and the whole of the Lohana community of UK, express our sincere condolences to the Queen and the royal family on the sad passing away of Prince Philip, the Duke of Edinburgh. Our thoughts are with the royal family at this difficult time. Welcome to this joint event organized by Minla and the Lohana community of UK. First of all, thank you Lalitbhai and Minaben for giving us this opportunity to host this valuable and important session on inheritance tax. Welcome Dipesh Bhai, and thank you very much for agreeing to impart your knowledge and advice to us all today. We're all looking forward to it, especially during this pandemic, COVID-19. Hope everyone enjoys the session today and learn new ways how to legally pay less or no inheritance tax on your well-earned fortune. Thank you for joining us today. I'll now hand you over to Lalitbhai. Jai Shri Krishna, Jai Jalaram.
Thank you very much, Sunilbhai. Now we'll be fast moving towards the speaker because I'm sure we all want to listen to the material that Dipesh has to share with us. So we all know that inheritance tax is widely viewed as unfair, and even the Chancellor is very much aware of it and agrees it's very, very complex. But only effective and early planning can minimize the impact on your estate. And we are truly hoping that we have got this wonderful gentleman, Mr. Dipesh Shah, who is going to help us get our thoughts in the line and get some good advice from him. Various questions have come up. We may not be able to deal with all these questions on time. However, we'll attempt our best to do so. If not, then we can directly connect with Mr. Dipesh Shah and get that information from him. I'm sure he'll be sharing his contact details over the Zoom session. But before we start, let me introduce the guest speaker for today, Dipesh Shah. After graduating from the ICMA Center in the Reading University with an MSc in International Securities Investment and Banking, Dipesh Shah founded Oakdale Financial Services on the 24th of January, the year of 2011, with the intention of providing financial services that are tailored to meet the changing clientele needs. Today, Dipesh Shah lectures over the Zoom globally, sharing the information that he has gained, and he wishes well for the community, and he's got some wonderful tips that he's going to be sharing with us. Currently, he's a wealth manager and a company director, as I said, at Oakdale Financial Services. Wealth of experiences advising his clients in important subjects like investing to build wealth and ensuring assets can be protected and passed on as effectively and as best as we can. He is currently the Oakdale Financial Services is currently partner practice of the St. James Wealth Management Group. Dipesh has got a few degrees on him. He's a very highly intelligent man, and as we said, a public speaker globally on the Zoom sessions, sharing the wealth of information. So without taking much time, ladies and gentlemen, we clap our hands, give him a big applause to welcome our guest speaker for this afternoon, Mr. Dipesh Shah. He's going to tell us about inheritance tax, inherently unfair. Dipesh, it's all yours. Welcome on board.
Good afternoon, everyone. Warm welcome from myself, and thank you to Meenaben, Dr. Lalit Bhai, Sunil Bhai, and also the Luhana community for allowing the opportunity for me to present to your community on something that I'm very keen to share knowledge on, and hopefully help you with your planning around this very, very important topic. So what I'm going to do now is I'm going to start the presentation by sharing the screen. I'll go through the presentation, and hopefully you all enjoy the presentation. And the key objective for this presentation is to help you understand or better develop your understanding of this very important tax and the steps that you can take to legally minimize the impact of inheritance tax. Great, so just a little bit of background about myself, and then I'll provide a background into St. James's Place. So I've been advising clients since 2006. I've been in the industry for over 15 years. During that time, I've managed to help a lot of people with regards to financial planning, inheritance tax planning, and other areas of financial planning. For me, it's I like the challenge, like look at different types of scenarios and trying to work out the best solution for that particular set of circumstances. So many years of industry experience. Oakdale Financial Services as a company, I started it up in 2011. Company's been running for 10 years. And my company is a partner practice of St. James Place, who's a FTSE 100 company who started in 1991, and they have over 129 billion pounds worth of funds. The aim, as I've mentioned, is really to look at or to help you to improve your understanding of inheritance tax, the steps that you can take, the actions that you can take, and also just to give you a flavor of some of the things that you should be thinking about or be aware of, because this is a problem that more and more people will be getting caught out with purely because asset prices are increasing. Allowances we've seen have become frozen, so therefore the requirement, the need to plan becomes even more important. So what we'll do in terms of the objectives, we'll have a look at some of the concerns that people have mentioned. And these are very regular concerns that I get from clients when I'm speaking to people, when I'm doing various webinars. At the end of the day, these are very common concerns, and you'll see that they probably also relate to your situation, and you'll be able to relate to these concerns. We'll have a look at some initial planning ideas in terms of what you can do. We'll explore the nil rate bands, how they work, what they are. We'll have a look at the rules, what happens when the assets are over £2 million, because there are some additional rules to consider which could have an impact on your wealth. What about the problem of inheritance tax at 64%? Yes, we're all aware of inheritance tax on assets at 40%, but what about the situation where it could be actually 64%? So we'll have a look at that. We'll have a look at the use of gifting and the 7-year rule, caper relief, how that works as well. So you have a clear understanding of the different areas of estate and inheritance tax planning. We'll also touch on wills and lasting power of attorney, which are an important part of financial planning. Of course, we'll have a look at trust, some different types of trust, how you can use them, and the benefits of using trust-based planning. We'll also look at, for example, whole of life insurance, how that can be a solution. And we'll have a look at a couple of other investment type solutions, such as enterprise investment scheme, business relief. We'll also have a look at main residence property planning. We'll then move on to question and answer. So a lot of the concerns we hear on a regular basis are around the amount of inheritance tax, including the cost of the estate and the ability to pass on funds money or assets onto future generations, of course, we want to be able to pass on as much of this money as possible. If you think about it, you've worked hard for a long time to build up this money. You want to make sure that as much of this money stays within your family and you're able to pass it on to future generations without the tax man or inheritance tax eating up a large percentage or large amount of the amount that you wish to transfer. What about the fact that we have to pay 40% tax at the point of death? We already pay a lot of tax during our lifetime. So for example, on any income or any rental profits, you're going to pay income tax. When you buy assets, you've got to pay stamp duty. When you sell assets, you made a gain, you've got to pay capital gains tax. Not to mention, we also pay national insurance, we pay VAT. If you add all of these taxes in, we are very highly taxed. So a large percentage of everything we earn will actually end up going in various taxes. And then of course, you've also got inheritance tax to take away. So clients have said that they want to give money away. Yes, it's nice to give money away, but at the same time, you want to retain control over the capital or the income. That's important. We need to make sure that when we're giving assets away, we don't give everything away, because we don't know what the future is going to hold. Your circumstances might change, your requirements might change. You might need access to the money after you've given it away, and it's not always possible to get the money back once you've given it away, because it might be invested. It may have been spent, it may even have been squandered. So a lot of things we have to be careful of when we think about inheritance tax planning. Sometimes we've heard that 7 years is too long to wait when giving money away. And this may be a problem if you're elderly, or you haven't done any planning, or your health conditions are not very, very good. Then the chance of surviving 7 years becomes more and more difficult. So what I would say, with any sort of planning, it's always worth trying to plan as early as possible. Everything is uncertain. Try and leave things in a nice or in a as efficient way as possible for your family, your loved ones, making sure that they get the benefit of your work as well. Sometimes people say there's not enough time to look at planning. Of course, I understand that lives are busy, a lot of things are happening, but it's one of those things where I think you have to put the time in, look at the situation, understand the problem, and take action to minimize your exposure to inheritance tax. And then also, people will say they're not sure if what they're doing is correct. A lot of things have changed. It is a fast changing area in the sense that there will be regular changes taking place. So again, really important that you review your planning on a regular basis to make sure that you're on track to achieve your financial objectives. So we'll begin by looking at some initial planning ideas. So we've just finished we've just had the end of the tax year, just over a week, just a few days ago. Now, the key thing is to make sure that you make use of your ISA allowances. Now, from a planning point of view, you get a lot of information around about March time saying make sure you use your ISA allowances. Now, using your ISA allowance is good in many ways. Like, for example, it's free of income tax. Any gains, they're free from capital gains tax. You have an allowance of £20,000. And if you don't use your ISA allowance within the year, then you're going to lose your valuable allowance. So yes, whilst we're all for the use of valuable allowances, such as your annual ISA allowance, £20,000, what we have to remember is there are some problems with ISAs. A lot of people will tend to hold their money in cash ISAs. As you know, cash ISAs do not generate any returns. The rate of interest on a cash ISA is typically around about 0.3, 0.4, 0.5%. If you're happy to tie it up for a bit longer, maybe 5 years, then the rate of interest is about just over 1%. So clearly, you can see that interest rates are poor. You leave all of your money in cash ISAs, the problem will be that the money that you've got in a cash ISA is not inheritance tax friendly. So that means ISAs will become part of your estate and then will be subject to inheritance tax. So if you've got £100,000, I use £100,000 as it's a nice, easy number. You've got £100,000, you're getting 0.5 as an interest rate. So that's £500. Yet at the same time, by keeping your money in a cash ISA, when you pass away, it will form part of your estate and you will lose £40,000 straight away. So clearly there's an imbalance. It doesn't make sense. You should certainly consider maximizing contributions to your pensions. So pensions are super attractive. There's a lot of benefits of putting money into a pension. So currently, if you've got earnings of £40,000, you can put in £40,000 in the current tax year. If you've got higher earnings and you've got some unused allowances, you can go back the previous 3 tax years. So currently we're in the 2021/2022 tax year. Once you've used up this year's allowance, you're able to go back 3 years to 18/19, 19/20, and 2021 tax years and put in pension contributions. Now, the great thing is when you put money in for pension contributions, you will get tax relief. So that's really important. For a basic rate taxpayer, if you put in £8,000 as an easy number, the government will give you £2,000 tax relief straight away, bringing your pot to £10,000. You're also able, if you're a higher rate taxpayer, you'll also be able to claim another £2,000 on your self-assessment. So really good. It'll cost you £6,000 to get £10,000 in your pension pot. The pensions can grow free of income tax, free of capital gains tax, and free of inheritance tax. You've also got access to the money. So it's a really, really efficient way of making sure that this money is in the most tax efficient environment. Then also, if you've got final salary schemes, it may be worth looking at those, because there may be planning that can be done with regards to final salary, providing the right circumstances for you. So in terms of pension contributions, really important to use it because it will help you. You've got access to the money in the future. Plus, it will help you from an inheritance tax point of view, because the money will be outside of your estate. We should consider making contributions to junior ISAs for children or grandchildren. So just like adult versions, you can have a cash version, you can have a stocks and shares version. Now, clearly, if this money is going to be invested for a long period of time, putting your money or putting the children's money into a cash ISA may not be the best use of that money. Because think about it, this money could be invested for 10, 15, 20 years. So again, it's important to use up the allowances. So we're saying use up your allowances, reduce the value of your estate from a tax point of view, and help your children. And your children or your grandchildren will benefit from junior ISAs or junior pensions, i.e. pensions for children, where they'll get tax relief on pensions. The money will grow free of tax as well. Plus, you will benefit from compounding, which is growth on top of growth. And you then see it's like a snowball. It gets faster as you get more further down into the future because of compounding. So again, don't miss out on those allowances. You should certainly consider taking advantage of your capital gains tax allowance. So every person has a capital gains tax allowance in the tax year. Now, some ideas that you could do, you could sell assets over different tax years. So for example, you could sell the assets. You could have sold some assets just before the end of the previous tax year, and you could sell some assets now in the current tax year. You may wish to split assets between husband and wife to use up 2 people's allowances. Again, therefore helping you to reduce the amount of capital gains tax you pay. The other thing you can do is you can consider deferring the sale of assets until your income tax position changes. So let's say, for example, you're a 40% taxpayer at the moment. Your tax position is going to change to 20%, or it's going to go from 20% to a nil rate taxpayer. Then it will make sense to defer the sale of the asset until your tax position changes, which means it's going to save you some tax there. So it's a more efficient way of doing it. We should make use of interspousal transfers, and we should certainly make use of any allowances where available. We'll now move on to the nil rate band, just to start looking at what the nil rate band is. For an individual, all individuals have a nil rate band currently £325,000. For a couple, it's currently £650,000, i.e. 2 lots of £325,000. Of course, taxation, budgets, allowances, all of these things can change in the future. So everything we're discussing is based on the position now. There's also something called the main residence nil rate band, which has been introduced since April 2017. So this is an additional allowance where you own a property which is your main residence or has been your main residence at some point in the past. For an individual, it's £175,000, and for a couple, it's £350,000, 2 lots. It applies to one person that has been, it applies to your main property. So if you've lived in various properties, you would nominate the property with the highest value. This allowance is only available when the property is passing on to your direct descendants. And this will include a child, including step, adopted, or fostered child of the deceased and their lineal descendants. It's a fully transferable nil rate band. Both the current nil rate band and the main residence nil rate bands are fully transferable. This means that if one person has passed away already and the second person was to pass away now or at some point in the future, assuming all assets passed over from the first person to the second person, then the full allowance of £1 million will be available, i.e. both allowances will be available, providing that the allowance is available, you're not above certain limits, which we'll have a look at shortly. Just for the purpose of clarification, when we're talking about individuals, I'm talking about people that are single or divorced. And for the purposes of couples, I'm talking about married couples or including widows. Okay, so what we're looking at is the total allowance in the current tax year for an individual is £500,000, and for a couple, it's £1 million. I will now have a look at the situation when assets are above £2 million. So when the government announced these rules about the changes, for example, introducing the main residence nil rate band, there were some restrictions also attached to it. Now, the main residence, so this applies to assets over £2 million. Now, it's not really, so you may have assets above £2 million, but obviously that's going to be a problem, or you might not quite be at 2 million. You might think, well, it doesn't really apply to you, but you have to remember that this the value is at the point of death, not at the value now. So bearing in mind, asset prices will increase. If you carry on building up savings, then property prices carry on going up, then more and more people will get caught by this assets over £2 million rule. Now, how it works is if your estate is worth, so what happens for every £2 above 2 million, the allowance gets reduced. So if your estate is worth 2.2 million, then you will lose £100,000 of main residence nil rate band. This will cost you £40,000. Now, if your assets are 2.7 million, then you will lose the full main residence nil rate band, i.e. the whole £350,000. Therefore, the only allowance you will have if your assets are above 2.7 million, the only allowance you will have will be the standard £650,000 nil rate band. So that is going to cost you £140,000 extra in tax. So we just need to be aware of this. Certainly if your assets are above 2 million, or if they're getting close to it, then we need to pay attention and take some action to bring you down or as close to 2 million if possible. So in this scenario, we're going to have a look at the problem of inheritance tax of 64%. Now, in this example, what we've got is we've got the first generation where they've got assets above the nil rate band, and the value of the assets beyond their allowance is a further £1 million. Now, when they pass away, there's going to be inheritance tax of 40% on this £1 million. So £400,000 has been wiped out. Moving on to the second generation, they will now receive a figure of £600,000. Now, this second generation have also done well in their own right. They've got their own assets, etc. And let's say, for example, they were to pass away just 5 years after the first generation passed away, then there's going to be a further inheritance tax of 240,000. So that means the original million has gone down just by the first generation. The second generation passing away just literally in just over 5 years. We've gone down to £360,000. So 640,000 or 64% has gone to the HMRC. The biggest beneficiary is the HMRC. The third generation is only receiving 360,000 or 36% from this original million. So really, really important to be aware of this. And this is where you need to make sure that you're looking at your planning, you're reviewing it, and you're taking action along the way. Don't leave it too late. The longer you leave it, the more difficult the planning will become. So now we're going to have a look at some gifting exemptions, i.e. these are some allowances that the government will give you to utilize. They are important to try and utilize where you can, but the biggest downside is that the numbers are actually quite small. These numbers haven't really changed for a long time, so therefore, as time has gone by, the value of these numbers has become less because of inflation. Okay, so you are allowed to give away small gifts to as many people as you like of £250. Now, the key thing is with this, you will save £100 of inheritance tax immediately. So there's no 7-year rule. You can do it straight away, but it's only £250 to as many people as you like. You're also allowed to give away an annual gift of £3,000. So this is your gift as the person that's giving it away. So between husband and wife, they've got £3,000 each. That's £6,000. You're also able to go back the previous year, i.e. if you haven't made any gifts in the previous year, husband and wife is also able to give £3,000 each. So this year plus last year, you could give away £12,000. Now, these annual allowances of £3,000, remember, they're your gifts. So it doesn't matter how many children or grandchildren you want to give it away to, the total amount you're able to give away is this figure that I've mentioned so far. The good thing with this is, again, it's going to be outside of your estate straight away. If your children are due to get married, then you're able to give away, as the parents, wedding gifts ahead of the wedding, ahead of the civil marriage ceremony. You're allowed to give away gifts of £5,000 each. Now, that is also a useful allowance because it's going to be outside of your estate straight away. So again, it's important to try and use these allowances where possible. You've also got the regular gifts from income. Now, this is an important allowance which is really underutilized in the sense that, first of all, there's no upper limit to how much you can give away. There is, it's purely based on your level of surplus income, and the revenue are happy for you to give away your surplus income as long as it doesn't have any detrimental impact to your standard of living. So for example, if your surplus income over the year after tax and all expenses is £30,000, you could actually give that money away, and that money will be outside of your estate straight away. There's no 7-year rule with that. So where you've got surplus income, if you don't need it, don't build it up in your estate, because as you build it up and it turns into capital, now it will take 7 years. Whereas if you give it away as it comes in, then you're distributing it out straight away, and therefore there's no 7-year rule. So that's very important. And then of course you can make donations to charitable organizations as well. So a quick summary of the numbers that I've mentioned so far: £3,000 annual gift allowance, £6,000 for husband and wife, £12,000 if you're using the previous year's allowance. Now, with these allowances, I've said that you don't want to really waste them, but I've said also at the same time that the numbers are quite small. But nevertheless, we should still try and make use of them where possible, because the government gives you these allowances. Some things that you could consider would be, for example, putting money into junior ISA contributions for children. So you can use up these various allowances. You can use up your surplus income. You can put contributions into junior ISAs for children and allow that money to build up in a tax efficient way. You could put money into pensions for your children, grandchildren. Super attractive, because when you give away £2,880, the government will also top it up by £720. So that will top up to £3,600. You can do this every year for as many children as you like. So what we're trying to do is we're trying to utilize the allowances and use the money in such a way that it's being invested in the right way, it's continuing to generate growth, and the children will benefit from compounding, especially over the long term. Certainly with pensions, they're very long term. ISAs are up to age 18 for a stocks and shares ISA before they can access the money. Okay, so far I've talked about giving away some small gifts, some small allowances that haven't really changed a great deal. Now, if we only rely on those small gifts, those small allowances, then to be honest, it's probably going to take quite a long time. Your planning probably won't work. We're looking at giving away some larger amounts of money. So what we're talking about is giving away larger sums of money, getting it outside of your estate sooner. And how it works, this brings us onto taper relief. So when you give away this money, what will happen is if you give the money away and you don't survive 7 years, then that will be treated as a failed gift. So therefore, that means you've used up your nil rate band if you were to give the money away and pass away within 7 years. Now, where this taper relief comes in is once you've given away more money than the nil rate band allowance. So the first 325 is your nil rate band. So let's say, for example, you gave away £325,000 today. You've used up your nil rate band, and then later on next week you give away another £100,000. So you've given away £425,000. Now, if you were to die in the first 5 or 6 or 7 years, the 325 there wouldn't be any benefit or any saving. You'd be paying the full 40% tax on that. But where the additional money you've given away, the £100,000, will benefit from what's called taper relief. Now, in this example, I'm going to show you how taper relief works. So if you've given this £100,000 away and you survive less than 3 years, then unfortunately you will not have saved any tax. The tax due will be 40%. If you survive between 3 and 4 years, then you have got some tax benefits, i.e. the tax payable will be 32%. Between 4 and 5 years, it drops down to 24%, 5 to 6 years drops down to 16%, 6 to 7 years, 8%, and if you survive 7 years, it's going to be 0%. That's where you're going to save 100% of the inheritance tax on this gift. So what I'm saying is, with regards to giving away these larger gifts, as soon as you realize that it's practically possible for you to make these gifts, use up these gifts, then ideally you want to try and do it as soon as possible, because the earlier you do it, the better your chance will be of surviving 7 years, and therefore the more effective your inheritance tax planning will be. We'll now have a look at trust and estate planning. So we're talking about gifting away during your lifetime, but there may be, so we'll talk about that shortly. We'll have a look at why you should have wills, lasting power of attorney as an important part of your overall planning as well. And I'll also cover off covering any liability with whole of life insurance. Now, so far I've spoken about giving the assets away, but it might not always be possible to give the assets away, purely because of the way the assets may be set up. Maybe to do with the capital gains tax. If you were going to give the assets away, there may be large capital gains tax liabilities to consider. The other problem to consider, well, obviously 7 years, you may need access to the money. Now, what we're looking at here is a different type of solution which will allow you to retain hold of the assets. Of course, the asset will continue to increase in line with inflation. But this is another solution where if you don't want to give away the asset, or you think, actually, I might need this asset because this is my long-term security. Remember, you don't want to give everything away. You might need these assets in the future. So what we're looking at is a whole of life policy. These are normally done on a joint life, second death basis. So that means joint life, husband and wife, it covers them both. And the policy pays out on the second death when the second person passes away. Now, in this example, I'm looking at covering £100,000 of inheritance tax liability. So here we've got, in this scenario, the applicants, the husband and wife, they're both in good health and they're both non-smokers. So you can see that helps from a premium point of view. So if they're both 45 years old, then the premiums to cover this £100,000 policy is going to cost you £75.94 per month. Now, that means if you keep paying this £75.92 pence, if you keep paying this £75.92 per month, your break-even point means that you have to live to 154 years old before the amount of money you've paid in equals £100,000. If you're slightly older, you haven't done it, you're 55 years old, it can still be done. It'll cost you a little bit more, £108, but your break-even point is still sufficiently healthy, 131. If you're 65 years old, as you get older, the risk increases that you're going to pass away. Therefore, the insurance company will put a higher premium. Therefore, it's going to be £160.79. Still need to live to 116 before you end up paying more than the policy is going to pay out. And if you've left it a bit late, you're 75 years old, you're still in good health, then yes, you can do it. It'll cost you £278.67 per month. You'd have to live to 104. Now, average life expectancy currently, on average, is around about 85, 86. So what we're saying is this is a good way of funding a future liability. What you're also doing is you're getting this capital or this money, which if you don't do it, it's going to carry on building up in your estate. So let's say you don't spend this premium, then that money is going to carry on building up in your estate. And that's also going to attract more inheritance tax. So what we're saying is this is the way to fund for the inheritance tax. You don't give away any assets, you keep the assets, you keep the security, you benefit from the income. Now, what we may also do as part of the planning, we may combine this with other types of planning. So let's say, for example, your liability is £100,000 and you've taken out this whole of life policy. If we can do some other planning and reduce the value of this liability from 100,000 to zero, and you've got this life policy which will pay out eventually at some point when you both pass away. So now we've created a surplus of £100,000 in your account. So you can see that that is very, very attractive way of doing things. Sometimes some people will use these policies because not only just for inheritance tax planning, but they may wish to leave a lump sum of money for the children, i.e. your view is, look, I've got these assets, I might use them, I might need them. I don't want to give them to children because you're worried something may happen in the future, i.e. the children misuse the assets, the children may end up getting divorced. So you want to make sure that they're still looked after. You could put together a policy, £100,000 to create a legacy, a lump sum. So you're using money to create a larger pot of money. So again, it's very attractive. Now this is based on non-smokers and being in good health. If you've got some health problems, blood pressure, diabetes, cholesterol, yes, it can still be done. But depending on how many of these types of conditions you have, it will have an impact because insurance companies work on the level of risk. The higher the risk is, the more the premium is going to be. So life insurance could be a good option. So moving on to trust. What is a trust? So trusts have been around for many years. They are a legal arrangement, and it allows the person who's making the gift, i.e. the settler, to give away assets to the trust. You will nominate trustees. You will appoint trustees to be the guardians, to look after the assets of the trust, and the trustees will look after the assets for the beneficiaries. Now, if you're giving this money away for your son or daughter can be the trustee, and they can also be the beneficiary as well. The good thing with these trusts is that you can transfer wealth from generation to generation. So for example, it can go to your children, to your grandchildren, maybe even to your grandchildren if the money hasn't been used. And also with trust, they offer significant protection. So for example, if you're worried that if you just give it to the children directly, they're going to just misuse it, then a trust is a good vehicle. If you're worried about the impact of divorce and losing 50% of the value of the money, putting it into a discretionary trust is a good idea. If you're worried about, okay, they've got this business, we don't know how the business is going to perform or if it's going to fail, then putting it into a trust will offer protection. Now, you have to be aware that if it offers protection as long as these things are done well in advance. If you're putting it into the trust today and you know tomorrow there's going to be a bankruptcy situation or a divorce, something like that, you know, is happening, then that's not going to work, because the trustees will say you've actually done this on purpose. So you've got to be careful. The earlier you do it, the better it is. When there's no when there's nothing, no such situation. If there is a situation, then it becomes more difficult, because the trustees of a divorce case or the trustees in bankruptcy will be interested in these assets that you've put into a trust to stop the other person or party from getting access to these funds. So they are very powerful. They allow wealth transfer from generation to generation. So in the previous slide, I mentioned the problem about the 64% problem, or the £640,000 problem, which was when the first generation passed away, the second generation passed away just 5 years after. Then you had that problem where the third generation was only getting the final balance after tax had been paid on tax. So what we're saying here is, in this scenario, if you've set it up into a trust and the first generation was to pass away, then the second generation, because we're talking about a discretionary trust, it doesn't have that problem of that 64% tax on tax that I've mentioned so far. So this is a good way to ensure that future generations don't keep paying tax on it, because otherwise that is a lot of money going in tax. So what I'm going to now look at is three different types of trust plans, and how these trust plans can be used to help you with your planning. How do you use them? Which types of trust are going to be suitable? So with all of these trusts, the benefits will be outside of your estate, providing you survive 7 years. It will allow you to use up your annual allowances, if we look at some of those numbers. Plus, it will also allow you to use up some of your nil rate band. Now, after 7 years, you'll get another nil rate band. So that means every 7 years, you could put money into a trust. So you could get quite a lot of money into a trust protected environment by doing a regular planning and gifting on a regular basis. Any growth that the trust generates. So let's say, for example, you put in £100,000. After 7 years, it's worth 150. The £100,000, of course, is going to be outside of your estate after 7 years. But any growth that's being generated, that's also going to be outside, because that belongs to the trust. You're able to take some withdrawals without any immediate liability to income tax, and we provide all the paperwork. So we do a lot of these trusts. We make sure that it's all set up correctly, and the paperwork is all provided. Now, the good thing with all of these trusts that I'm discussing now is from a paperwork, from an administration point of view, they're pretty simple, straightforward to administer. There's no self-assessment, no annual declaration, no annual filing of accounts or reports that you need to submit. So that just adds to the attractiveness of this type of product. So the key things are, it will allow you to make use of the exemptions. It allows you to put together money to pay for your children or your grandchildren's school fees or university fees. So that's a good use of that money, university fees, college fees, etc. Maybe buying a car, setting up a business, using it as a deposit for a property. So there's a lot of uses that that can be provided through the use of trust. It ensures that the proceeds of the gift plan are received by your beneficiaries, i.e. your beneficiaries can receive this money quickly without any delay. And like I said, when we're using a discretionary trust, it doesn't form part of the beneficiary's estate for inheritance tax planning. So that means that the subsequent generations, they're not all paying tax on this money. Okay, so what we're saying is we want to protect as much of this money for the future generations. The next plan we'll have a look at is the discounted gift plan. The key benefits with this plan are, it will allow an immediate reduction in your potential inheritance tax liability, and I'll show you an example of how this can work. This will provide you an income for life. So very useful if you've got this sum of money, £100,000 that you'd like to give away because you've got an inheritance tax problem, but you're worried that you still need an income to meet the cost of living, cost of expenditure, then this will allow you to take a fixed income of up to 4% per annum. And that's regardless of how your investment performs. You're guaranteed to get this income. Now, what that means is if For example, your money is growing at a rate of more than 4% and you're taking 4%, then your fund value will be increasing in value. If you're taking 4% and let's say that the 4% that you're taking is greater than the rate of growth, and that means that your fund value will be getting depleted. So it's a case of trying to make sure that you're above that 4%, so you get your income and the fund will continue to grow over a long period of time. There's no inheritance tax providing you survive 7 years, so some of it will be outside of your estate straight away. Some will be out. Some of this money will be outside of your estate within 7 years. So very, very powerful tool when you need to combine inheritance tax planning and you need income. And the great thing with this product is that you can do it without breaking the gift with reservation. So gift with reservation rules are very strict. So if you give away an asset and then you take a benefit, i.e. you receive a benefit, then the revenue will say, what have you actually given away? Because you've given the asset away, you've still got the benefit. So therefore the revenue will say, we're still going to include that in your estate for inheritance tax. This product will ensure that you don't have that problem. Again, any future growth will be outside of the estate because it belongs to the trust, and there are potential immediate tax savings, which the next table will show you. So in this example, we're giving away £250,000. You're taking 4% withdrawals. So at the age of 60, the value of the discount, i.e. the value of this money that's going to fall outside of your estate, is going to be £138,000. Now, it's worth pointing out that these figures are based on a HMRC formula based on your age, your health, your medical conditions. All of these factors are taken into account. But the key thing is when you've put this £250,000 in, £138,000 will be immediately outside of your estate. From a tax point of view, this means it's going to save you £55,200 straight away. If you're a little bit older, let's say you're 70 years old, you're still going to get an upfront saving of £43,200. A little bit older, 80 years old, it's still worth it. You're still saving £29,600 pretty much straight away. So very powerful form of planning here. Loan plan. So slightly different to the other two. The other two have required you to give away the capital. The first one required you to give away the capital. The second plan, discounted gift plan, required you to give away the capital, but you get access to an income. What happens if you need more flexibility? What happens if you're not sure that you can afford to give this money away, but you still want to do some inheritance tax? What if you think you might need this money in the future? Then what we can do is what's called a loan plan. So with this loan plan, you're making a loan to the trust. Now, this money is going to be available for you to spend. So that loan that you've given is always going to be in your estate from an inheritance tax point of view. Obviously, as you spend it, it's getting outside of your estate. Therefore, the amount of inheritance tax will reduce. With this particular plan, you're saying, I need access to my capital, but I'm happy to give away the growth on my capital. So you put in £100,000, you've always got access to the 100,000. And let's say the 100,000 grows to 150, that £50,000, that growth, that's what you're giving away. So you've got flexibility, the money is in your estate, but you're giving away the capital. So again, where you need more flexibility, this could be an attractive option. And it might be you need to top up, you need some extra money, other things that you want to spend, or you might think you're not quite at that stage where you can just give away the assets, you might need it. So again, this is going to be a good way of doing it. And it may be a case of combining it with the other trust to come out with the optimal solution for your circumstances. Loan plan. So investment growth is immediately outside of your estate. You have the ability to recall this loan at any time. Okay, so that's fine. The uses. So you can take additional capital or income to supplement your income or your lifestyle, and it's a good platform for other types of inheritance tax planning. Moving on to other solutions now, we're going to look at using an enterprise investment scheme solution. So these may be attractive to you. For example, we mentioned that 7 years might be too long to give away to survive. So you might be trying to do something a bit quicker. you might not be in a position to get life cover because the premiums are expensive because of age, or maybe because from medical health point of view, you may not be insurable, or if you are, the premiums could be very, very high, which might make it prohibitive. So you're looking at other types of planning. So with regards to the enterprise investment schemes, I will say that these are going to be a higher level of risk than other investments. They're not going to be suitable for all investors because you may not be comfortable with the level of risk. Although there's tax benefits, you've also got to be comfortable with the level of risk. If you've never done investments before, then something like this would not be suitable. So what we're saying is, yes, there are tax benefits, but we've got to balance that off against the risks. The tax benefits you get on this enterprise investment scheme, first of all, you can get income tax relief of 30%, maybe claimed back through an enterprise investment scheme. And this will apply to any money that you have paid tax on. So any income, dividends, rental income, whereas when we spoke about pensions, you could only use income that you've received from employment. So there are some restrictions on what income you can use in terms of pensions, but in terms of this, you can get 30%. So you'd either get a rebate, a rebate, or it'd be reduced or balanced off against your previous year's figures. It gives you capital gains tax deferral. So if you've sold assets within the last 3 years and you've made capital gains, then what you can do is you can defer the capital gain by investing this money into an enterprise investment scheme. Of course, if you come out of the enterprise investment scheme at some point, the capital gains will still be payable because all you've done is defer it. Now, if this product is held till the point of death, then that means capital gains tax by that stage has been wiped out. So you can use it to defer it. On property for high rate taxpayers is 28%. Property for basic rate taxpayers is 18%, and all other assets is 10 and 20% basic rate and high rate tax. So you've got income tax relief, you've got some capital gains tax relief, you've also got inheritance tax relief. So once this product's been held for the qualifying period, you will achieve inheritance tax benefits as well once it meets the qualifying criteria. So there are a lot of benefits, but you've got to balance off the risk. You wouldn't just do it because of the tax breaks. You have to understand the product in full. You have to understand where they invest the money. And what we do is with these types of enterprise investment schemes, we try and diversify the money between different investment managers, look for different sectors, different investment styles and strategies. And all of that will help you to reduce the risk. And although I said they are high risk, they can still be suitable for a proportion of your money as part of your overall planning. Here we're looking at business relief. So this is where you invest in unquoted companies, unlisted companies, as long as you hold the holdings for 2 years, and the holdings you've held them at the point of death have been for 2 years, then you will benefit from inheritance tax relief, i.e. You'll save the inheritance tax. So previously, companies that were unquoted or unlisted were companies like, for example, Rightmove, Secret Escapes, Zoopla, Majestic Wines. These are well-known companies, good-sized companies, good turnover, good profits. But for their own reasons, they decided to list on the alternative markets as opposed to a full listing on the exchange. Now, what it's showing you here is the chances of surviving 2 years and 7 years. So the 2 years, if we talk about the 2-year product, i.e. this business relief, the 7 years is talk about giving away assets either directly to the individual or via a trust. So what we can see is at age 80, there's still a good chance that you could survive 2 years. There's a good chance at 85, even at 90. Now, in terms of this, if it's a husband and wife that have done it, as long as one of them survives 2 years between them, then that's fine. So let's say one of them passes away. It was done last year. One person passes away now. Then as long as the second person survives 1 more year, then you've met the 2 years qualifying criteria, and it's going to be outside of your estate. So where you may have money in your bank accounts, £100,000, earning 0.5%, £500, being subject to inheritance tax at 40%, you might think, well, actually, it might be better to go into one of these types of solutions for some of that money, because maybe health-wise you can't get life insurance, 7 years is too long. There may be a whole range of reasons why this planning may be attractive to you. Now, in terms of enterprise investment schemes and business relief can be considered less risky, because enterprise investment schemes is all about small companies, startup companies, where there is a higher risk of failure. So this might be a useful way to supplement your planning. Main residence property planning. So a lot of times when I go to meetings, a lot of people will say to me, I'll just give my residential property away. I'll carry on living in the property, and my inheritance tax planning is solved. I wish it was that easy and that straightforward, but it's never that easy, never that straightforward. Now, whatever name you want to call, i.e. give a share of your property, transfer, add your son or daughter, it's essentially got the same, it will have the same impact, i.e. Let's have a look at these two scenarios and see what will happen. So in the first scenario, you could get your children are living with you at the moment. You could give your property away, your children could live with you. That's absolutely fine. Now, in this scenario, you have to equally split the running cost of the household. This 7-year gift, again, the 7-year rule will apply. So you'll still have to, and the 7-year rule will apply not from when you made the gift, but from when you both were contributing equally to the running cost of the house. So that's fine. That works if your intention is to stay together for a long period of time. The second solution is you give the property away. Your children don't live with you anymore. So maybe they used to live with you previously, they've now moved out, or they just don't live with you. In this scenario, you need to pay rent to your son or your daughter for the share of the property that you have given to them that you are still occupying. So it was originally your property, you've given away a share. So let's say you've given away 50%, then you'll have to pay 50% of the market value of the rent of this property. Now, there's no such thing as a family rate or discounted rate, because the revenue will want to see that it's been done on the correct commercial terms, i.e. the correct market rate of rent has to apply. Now, once you pay this market rate of rent, your children, because they're receiving this money like any other rental income, of course, they have to pay income tax on this money. Now, as you're aware, the allowances on property have become less and less generous, i.e. the interest on tax is gradually reduced the amount that you can offset. So again, it's just really important to be aware of this planning. Sometimes people think, well, just give it away, that's easy. But unless you're following these two scenarios like I've described, if you just give it away and you don't do anything else, then you haven't achieved any inheritance tax planning benefits. In fact, all you've done is you've introduced risk, because now your children own a share of the property. Now, I'm not saying your children will force you out from the property, but maybe they marry the wrong person. You need to consider that. You're losing control, you're introducing risk. You could be forced out of the property. I mean, nobody can tell what's going to happen. The other scenario that could happen, the marriage doesn't work. The son or daughter's marriage does not work. Therefore, the asset that you've given away now belongs to, will now be subject to divorce, i.e. A percentage of that will go to the other person. The asset that you've been trying to protect, it's not going to go how you want it to go. So just got to be very careful with property planning. It's never as easy, straightforward as people think. The other thing to bear in mind is that if it's a rental property that you're giving away a share, or adding your child's name, or doing anything to it of this sort, then you have to remember that's treated as a disposal by the HMRC. That means you've got to pay capital gains tax. Once you've paid the capital gains tax, remember, you still have to survive 7 years. So capital gains tax you're paying is on the gain you've made on this asset. That's capital gains tax. if you end up surviving less than 7 years, you will also end up paying inheritance tax. You've got to be careful. Could be two lots of taxation there. Now, one of the things that we do often come across is when we talk about giving away gifts over 7 years, or we talk about when we talk about any gifts over 7 years, a lot of times we will recommend that you back it up to be 100% effective with a 7-year life policy to match the tax that's going to be due on the gift that you've made. Now, 7-year life policies will be more cost effective than, for example, whole of life policies, which go on for a longer time, i.e. there's no end date. You've also got policies up to age 90. So there are different types of scenarios, there are different types of options available. Moving on to inheritance tax, your options. So far I've described a lot of things. What I'm going to do on this slide is just summarize the key options you have available to you. Number one is you can put the money into a trust, like I've mentioned. Number two, you could decide to protect your gifts using whole of life cover if you're not planning to give the assets away. You could also look at other types of life cover if you're planning to give the assets away. You need to look at tax efficient investments such as business relief, enterprise investment schemes, and you may wish to spend or give your money away. Now, option 4 is actually probably the most difficult out of all of them. If your assets are tied up in bricks and mortar, property, or assets that are going up, how much are you going to spend? And you're not just going to spend the money for the sake of spending this money. At the end of the day, you've looked after this money, you've built it up. You're not suddenly, I think it's very difficult that you're suddenly going to do something that you haven't done all these years and just go and spend it. And also, what would you spend it on? So again, it's very, very difficult to achieve number 4. So now I think it's useful to have a summary of all the things that we've discussed. So we're coming to the end of the presentation. So we looked at the different concerns that people have with regards to the amount of tax that's payable when you pass away, the amount of tax that's paid during our lifetime, 7 years may be too long, health issues. You may need access to money. These are all things that will relate to everyone's situation. You have to take all of these factors into account. We looked at some initial planning ideas, i.e. ISAs are not very efficient from a inheritance tax point of view. Pensions are a very good use of allowances, and you should try and manage your capital gains tax by planning these things ahead, like I've mentioned so far. I've talked about nil rate bands, 325 for individuals, 650 for a couple, 1 million for a couple, including main residence nil rate band. And I've talked about what happens to assets above £2 million, i.e. your allowances starting getting reduced, and also the problem of inheritance tax at 64%, which is a very real problem. It's not unrealistic. It's totally not unrealistic for this scenario to happen. Of course, we've talked about giving away some assets. There were some small numbers that I've mentioned so far because they haven't been updated for a long time. But you'd also wish to consider giving away larger amounts. If you've got these assets and you're not using them, then don't hold on to them, because the longer you hold on to them, the more the value will increase in time. Therefore, there's going to be capital gains tax problems, more inheritance, the longer you hold on to these things, the more difficult it's going to get to plan. So try and think about what you can afford to give away. Obviously, you don't want to give away everything in one go because you might need it. So it's planning the best way to do it. But remember, as part of your planning, make sure you leave yourself with enough money. Don't leave yourself in a position where you've worked hard for 40, 50 years, you've given everything away, and you have nothing left in your name. We've seen many cases where the planning people have done is we'll give it away to the children. Something happens, it creates a lot of risk, a lot of complications. You should get wills, lasting power of attorney. Lots of times people say, oh, we haven't done it. We haven't had a chance to. It's one of the most important things you need to have a look at, because let's face it, if something happens, you want to make sure that your assets will get distributed according to your wishes. There's no downside in having a will. If you change your mind later on, you can change it. Power of attorney is if you lose mental capacity due to accident or illness. Really worth having. I talked about the different types of trusts. They offer protection against bankruptcy, against divorce, and they allow you to pass this money from generation to generation and avoid that problem of the 64%, which I've mentioned so far. I spoke about covering using different types of insurance, 7-year policies to age 90, or whole of life, depending on the scenario, and of course the cost of the premiums as well, which is going to be based on your health and age as well. Then other things I looked at: enterprise investment scheme, business relief, maybe not suitable for everyone, but certainly there may be a place as part of your overall financial planning. So what we're saying is, the more of this planning you do, the more robust, the more efficient it's going to be, the better your planning will be. A lot of times when we're talking to clients, it's not one solution will do everything you want to do. You have to look at all of these different solutions, and some of them may be relevant to you now, some will be relevant to you later on in the future. And then just got to be careful with regards to main residence property planning because of the scenarios 1 and 2 that I mentioned. So thank you for listening. This brings us over to question and answer. And yeah, that's my presentation. I hope you've enjoyed that so far.
Thank you, Dipesh. Thank you very much. It was an extremely informative session. A few things going above our heads because this is like numbers and what the planning and the finances and everything. So before I go ahead, I saw you shared a slide about your contact details. This is the thing. I'm sure people here who have logged on will have questions that they would want to ask you personally, or they have their specific scenario that they may want to discuss with you. Would you be okay just saying your details out as your contact email or
Yeah,
or
yeah.
number? Please go ahead.
Sure, Dr. Lal. Let me share the screen again with you.
Sure. So, ladies and gentlemen, do take some details down. I'm sure the information Dipesh has shared with us is very valuable, and we may not have caught on to everything. So, if you need to contact him, the telephone number is 0208 150 7565, and the email is dipesh.shah@sjpp.co.uk. Keep the slide there for 30 seconds more, Dipesh. If people want to take a quick photo of the slide, then they can go ahead and do that and keep your contact details so that they can actually contact you. Dipesh, thank you very, very much for the presentation. We can stop the screen share now. And if it's okay with you, we can go ahead and go into the question answer session.
Sure.
Ladies and gentlemen, there have been several questions that have come on the previous to the Zoom session. There are several coming up on the chat box. And I will request Mr. Dipesh Shah to take the questions that have come up on the chat box. Now, with a view, ladies and gentlemen, that everything may not be able to be answered to your specific case because each case is individual. So I do encourage, if there is information that you personally require for yourself, contact Mr. Dipesh Shah. However, we'll try and entertain every question that has come up, and we'll try to take the chat box questions right away. And at this moment in time, we do have several questions on paper prior to the Zoom and a few on the chat box. So Dipesh, at any given time, if you find it that these questions may be relevant on a one-to-one discussion, please feel free to say so, and we'll certainly honor your decision on the questions and the answers you're giving us. So, quick question that has just come through. Assets over 2 million. Does this mean their NRV of 325K gets reduced?
So the £325,000 never gets reduced. You'll always have the 325. It's only the main residence nil rate band, the £175,000 for an individual, or £350,000 for a couple. That's the allowance that will get reduced. So the minimum you will always have for a couple is £650,000.
Great. Second question: person's already taking a pension. Can he or she still contribute towards personal pension plan? And what is the limit and up to what age?
So the maximum they can put in as a contribution is £2,880. The government will give you £720, bringing it up to £3,600. the maximum age you can do this for is up to the age of 75. After 75, you won't get the tax relief. So it's not worthwhile after 75. But in the meantime, we always encourage clients to put money into this pension, just because if you've got this money lying there, not getting any interest, you're getting £720 straight away. You're getting 20% tax relief. So that's very attractive. Plus, the money will grow and you're getting tax relief. So that's attractive, yeah.
Great. Dipesh, we're putting you on the spot right now. You've got figures on top of your head. That's great. Thanks to you for that. Some people are selling property or businesses as little as pound, whatever, and it's a very complex system. Who is able to give cost-effective or free advice, etc.? Thanks again and very well done. And this is from the Lohana community.
So what I would say with those, especially if it's inter-family related transactions, i.e., if you're selling these assets to your children for £1 or whatever, then the HMRC will certainly be interested, because at the end of the day, that's the deprivation of asset. They're not getting, if you're selling it for those values, they're going to be losing out on tax. So you've got to be very careful with that. They are looking at more and more inter-family transactions. If you're selling these assets for a ridiculously low price, and they know that even if the asset is £1 million, the house, and you're selling it a little bit lower value, £800,000, the revenue will still be interested in that. So I'm not sure where you'd go for in terms of free advice on that, but what I would say is be careful. Free advice could end up being very costly in the long run. So free or cheap advice may create more problems down the line. You just don't know.
Great advice. Thank you for that. Dipesh, the other question comes and it says, the gentleman says, correct me if I'm wrong. Once you gift your property, am I correct in saying that you can't live in that property or else you have to pay rent?
If you live in the property and you've given the property to your children who don't live with you, then you will have to pay rent. If your children live with you, then you will have to split the running cost of the household. And that 7-year rule only starts once you start the equal payments. You have to contribute equally to the running cost of the household.
Yes, I think you discussed that in your presentation. So that's again well asked and well answered once again. Next one goes to, if you transfer your property to your heir and you live for 7 years, so your property is transferred already and you live for 7 years, does that property become tax-free?
Only if you follow the conditions in scenario 1 and scenario 2. Scenario 1 is you all share the running cost of the household. Scenario 2 is you pay rent. Now, if you don't share the running cost, or you don't pay the rent, as in scenario 1 and scenario 2, i.e. you just give it away, you carry on living there, you don't do anything else, then the revenue will say, what have you given away? This will be breaking the gift with reservation rules. So the gift with reservation is you're giving something away, but you're still getting a benefit. So the revenue will say, what have you given away? So let's say you've got £1 million property, you've given it away, you've survived 7 years, but you haven't followed the scenario 1 or scenario 2, then that £1 million property is still going to be in your estate for inheritance tax purposes. The planning you've done will not be effective.
Thank you. The other question that has come up is, how can you protect your main residence against care home costs?
So if care home concerns is one of the big concerns, you can look at some tenants in common, splitting the property into two. That could offer some protection, but again, with anything, it has to be done well in advance. If you just do it before the event, then you're more likely to get a challenge from the local council. So again, you've got to be careful with that. But also the other thing you've got to think about. So a lot of times people do talk about care home expenses. They're expensive, i.e. an average home will be roughly about £1,000 a week, maybe £1,250 a week. So we're not talking 5-star accommodation. We're talking pretty standard, pretty average accommodation. But where people have to be careful is a lot of times people are worried about a care home, but nowadays with treatment, a lot of people do actually prefer to have treatment actually in your home. You can have carers that come in. So unless your health is really bad, or you need intensive care around the clock, most people, we find in our experience, don't necessarily always go into a care home. They may prefer to have the treatment or in the comfort of your own home. You pay for them on an hourly basis as you need the care. So in terms of that, the probability, the possibility, not everyone goes into the care home. But
Okay.
but if there aren't any other family members, then you want to make sure that you've certainly made provision if you need to go into a care home, because I think the worst thing would be you've worked hard all these years, the last maybe 5 years of your life, you want to be able to probably just enjoy it without too much worry about, you don't want to deprive yourself of having good care.
Good. Thank you very much. I've taken most of the chat box questions. I'm going to go into the questions that were earlier presented to us. So the question goes, Dipesh, when you gift from excess normal income, that is income in excess of normal living expenses, how should you document it? Is there some official form that needs to be filled out?
So the name of the form you need is the IHT 403 form. You should, with any of those allowances that I've mentioned, you should keep accurate records, i.e. you should have good record keeping. So if you're giving away this £3,000 annual gift, you should have a letter in the file saying, I've given away this £3,000 annual gift to my son or my daughter. It's a gift. I don't need the money back. This is the date I made it. And have a copy of the bank statement, attach the bank statement. If you circle it, that's even better. It's just so that they know that when they need to claim these allowances, that actually they can look at that and say, yes, this is the allowance we've used. Try and make life as easy, as straightforward as possible. Otherwise, you're going to incur a lot of probate fees, because the more work that is involved for probate, the more the fees will be. Now, IHT 403, you fill it in. Now, that exemption, it's applied or claimed at the point of death. So therefore, the record keeping is really important. Keep the records, keep the data, and keep it updated as well. Make sure the family members know where these records are.
Great, thank you for sharing that. Next question is, if an Indian living in India, I appreciate these are different law of the land is different, but this is a question that has come up. If an Indian living in India has a house in the United Kingdom, say worth £750,000, does inheritance tax apply to him or her?
So this question will depend on your domicile. So if you're UK domiciled, i.e. you've just moved over to India recently, you haven't severed all ties to the UK, then you're still going to be liable to that, plus worldwide assets. If you're non-UK domiciled, i.e. you came here 30 years ago, you bought a property, then you went to India or Kenya, and you've got nothing else to do with the UK, no family members, no ties to the UK, and you've severed all ties, and you're treated as a non-domicile, then you will only pay tax on the assets that are here within the UK. So the £750,000 will be above your £650,000 nil rate band. So therefore, there would be tax payable.
Okay, great, thank you for that. The next question was, how can you use the child's personal allowance to pay for their education? So you can buy a property in the child's name or a trust, or use their PA against the income? So
children or minors under the age of 16 are not allowed to hold assets. The only way you can hold an asset for the child's name is to put it into what's called a bare trust or an absolute trust. Now, what you've got to be careful of is when you're putting this money in to a trust. So let's say, for example, you're putting your money into a trust, and this trust is generating an income of more than £100. Then the problem is then the revenue will assess it against your income. So you can't use the trust to put your money in, get the income, because the trust will say, well, we're going to assess it on the parents. Obviously, the rules are different for grandparents. If the grandparents are doing it for the benefit of their grandchildren, then it's not assessed as part of their income, whatever that income is. It's not assessed. And then the children, they've got personal allowances of £12,500. So a baby born today, day one, they've got an allowance of £12,500 per annum. So you may wish to utilize their allowances, but there is a distinction between parents doing it and grandparents doing it.
Thank you for that. Next question comes up as, do you pay CGT if you sell an inherited property upon inheriting it?
So let's say the value of the asset was bought a long time ago for £100,000. The value is now £500,000. The person who's passed away, there's no CGT there. There's no CGT on death, but the person that's inherited it, they're going to inherit it at the value, the current market value, which is £500,000. Now, if you sell it and you sell it for £500,000, then there's no capital gains. So there's no CGT. But let's say you leave it for 2 years, and the value goes up to £525,000. Then there will be a little bit of CGT above the base price that you inherited the assets. If you inherited at 500, you have to minus your allowances, and then the balance will be subject to CGT. But generally, if you've just received an inherited asset, there's not going to be any CGT because you're just getting it at what the value is. Unless the asset shoots up quite dramatically, there won't be any CGT to worry about.
Great, thank you for that. The next question is, this is from an insurance broker who says, would my business qualify for business relief for inheritance tax? If yes, then what percent?
So if it's purely insurance brokerage, I mean, for that we'd have to get a bit more information, understanding of what it is that this business is doing. If the business owns a freehold property as well, then the freehold property or the building will not qualify. So we're talking purely trading businesses. We'd need more information about what type of trading business it is. If it's a normal standard business that meets the definition. So when you talk about insurance brokerage, there's a range of things that it could mean. So what I would say is, if it meets the qualifying criteria as a trading business, it should get 100% tax relief, i.e. Business relief. You should get 100% of the business relief allowance. What I would say, to be 100% certain, you should just double check this with your accountant in terms of the type of trade that you're involved in. Is it a qualifying activity? Because some activities will not be a qualifying activity for business relief purposes.
Great, so thanks for that too. Next question says, who pays the inheritance tax? Is it the estate or the beneficiary?
So it comes out from the estate, and then once the inheritance tax has been paid, that's when the beneficiaries will receive the assets.
Great. What happens to the ISA on death? I think you touched on this point while you were presenting. What happens to the ISA on death? Does it form a part of your estate?
It will form part of the estate, yes. ISAs will become, so they're tax efficient during lifetime, but on tax friendly. So the ISA will generally.
Okay, Dipesh, I think we're having some kind of a breakup there. We couldn't quite connect. The answer has gone missing. So if you want to repeat that answer again, please. I think there is a little bit of a network issue where the screen has frozen. Dipesh, can you hear us?
Oh, sorry.
Okay, can you hear us, Dipesh? Because I think the screen is all frozen right now.
I can hear you, yeah. Dr. Light? Oh yeah, can you hear me now?
Yes, we can.
Okay, so ISAs during lifetime are tax efficient, tax friendly. On death, they lose the qualifying status that it will be part of your estate and therefore will be subject to inheritance tax. So if you've got, for example, cash ISAs, I've said that cash ISAs might not be the most suitable use of that money. If you've got investment ISAs, then if the value is increasing, then your inheritance tax liability is also increasing. So maybe the vehicle is not quite the correct vehicle because the ISA is not going to be helping you from an inheritance tax point of view.
Great, thank you. So we all believe that ISAs are lifelong and you can avoid the tax and everything, but obviously not at the time of death.
No.
Okay. How is my pension pot treated for inheritance tax on death?
So pensions are free from inheritance tax. Any money in a pension is always going to pass to the estate free of inheritance tax. Now, there are a couple of different scenarios where if you were to die before 75, then the whole money gets paid out as a lump sum or as an income free of tax. If you were to die after 75, if the benefits are taken as income or lump sum, then they will be subject to the beneficiary's marginal rate of tax. If you're a 20% taxpayer, you will pay 20%. Obviously, if it puts you into 40%, you'll pay 40% tax on that money, but that's going to be income tax as opposed to inheritance tax. And also the other good thing that they've done recently, a few years ago, with regards to pensions, is that they can pass from generation to generation. So any money that you've not used, before you had to purchase an annuity, now you don't need to buy an annuity. If you got other income, other savings, other assets, you're always better off using that money, spending that money first, than spending the money in a pension, because the other money is maybe not earning any returns because it's in cash and it's in your estate for inheritance tax. So better to spend that money. The money in your pension is in a tax protected environment. The money is growing. You don't want to use that money. If you can just pass on the pension from generation to generation, you can see that that's going to be a very, very powerful, effective way of passing money in a tax protected environment from generation to generation, i.e. make the money last for a very long time.
Thank you for sharing that tip. I'm sure people listening to this will take that on board and should take it on board. Thank you very much for that one. If one person receives shares in a private company from his parents, and there is no ready valuation of the shares, how is inheritance tax calculated?
So the accountants will have a number of different ways to value the company shares. A number of different ways. I would suggest to speak to your accountant, get a valuation, and then that value is the figure that's going to be in your estate from the date that the shares got transferred.
The next one is, if the beneficiary of a property or cash is a resident in another country, is the inheritance tax calculated or based on the country of residency?
Sorry, could you just repeat the question, please, Dr. Lalit?
Yeah. If the beneficiary of the property or cash is a resident in another country, is the inheritance tax based on the country in which the person is resident?
That would require a little bit more understanding of that question, because there's going to be differences between different countries. So we need more information to help on that one.
Sure. So depending on the country, and I think this is something that individuals should be able to locate.
Yeah. What I would say is, if they're living in different countries, so we focus on UK law, UK legislation. What I would say, because every country is slightly different, would be to seek local advice in the country that you're talking. So if we're talking Kenya, get the advice in Kenya. If we're talking about India, then we talk about India, because the assets are situated in those countries. If the asset is situated here in the UK, going back to like one of the other questions that we had earlier, then there will be tax on the UK asset. But if you talk about local assets in a different country, get the local advice to be 100% correct.
Thank you. Thank you for saying that, Dipesh. Sometimes these are very case-specific questions, and obviously the law of the land applies to the resident and the benefit, the person who's getting all the benefits. So, ladies and gentlemen, a great answer. Please do get some local advice if this is the situation you are in. Great. A quick question over here says, if one is a beneficiary in a trust abroad and is a UK resident, what tax and inheritance tax implication for UK residents? This question doesn't come out very clearly, but it says, do the asserted passed to you as a beneficiary? Okay, so these are some questions being repeated from different continents, different countries, whether you're taxed in UK or in both countries. So ladies and gentlemen, as Dipesh has requested, find the law of the land, and then you can always connect with him on the UK basis of inheritance tax. Okay, so moving up onto the next one. Are there any tax benefits of setting up a trust as a tax planning measure so as to minimize inheritance tax?
Sorry, could you repeat that question, please?
Sure. Are there any tax benefits of setting up a trust as a tax planning measure so as to minimize inheritance tax?
Sure. So trusts are a really powerful tool. They allow you to transfer wealth from generation to generation. They allow you to have significant asset protection in the event of divorce or bankruptcy. And it still allows you to maintain control. So putting the money via a trust is a very efficient way. And a lot of times we see that that is better than giving it directly to the beneficiaries.
Okay, I hope that answers the person who asked that question. Now, there is a little bit of quite a broad topic discussing on digital assets and things like that. Would you be able to comment anything on digital assets? Because there is a question based on that. And I just wanted to make sure before I ask, it's a very broad question. I will ask and see what you can answer to that, if that's okay with you, Dipesh. Are digital assets such as social media accounts, online presence, and digital data classified as an asset subject to valuation in setting up an estate account?
Unless you're like a film star or a movie star and it's got value, i.e. the brand or something. If we talk about your social media account, if I've got a social media account, it doesn't really have any, there's no tangible value to a social media account. So obviously celebrities may be different, but for normal people, everyday people, I don't really see that there's going to be any value unless you've got something amazing or you've got some copyrights or something that you've got, but I don't know. I wouldn't classify those as valuable assets.
Okay. Now, there's a question that has come from Kenya, and it says, Kenya currently does not have an inheritance tax. However, do we see this changing in the near future?
I have no idea.
Thank you for being very honest on that. Great. Capital gains tax in Kenya explicitly provides for the exemption on gains attributed from disposal of property for the purpose of administering the estate of a deceased person's property. Could you elaborate on any pitfalls to avoid any complaints, example, maximum period, documentation, etc.?
So with documentation, with everything, I'd always recommend make sure you've got good documentation, good record keeping, vital. I know a lot of things like Kenya, India, record keeping systems are not maybe as good as they should be for whatever reason. I would say again, with regards to capital gains tax in Kenya and the actual process involved, I would say seek local advice, and it might be from accountants in Kenya who deal with capital gains tax, or it may be from taxation experts, accountants or taxation experts in Kenya. They would be best equipped to answer that query for you.
Okay, I think part of the next question you've answered about getting local advice, and part of this question that I'm about to ask you, you may be able to shed some light on it. So the next question goes is, if one holds a dual citizenship of a country that does not practice inheritance tax, example Kenya, and also is a resident of a country that has inheritance tax, that's United Kingdom, how would the inheritance tax affect this individual whereby he has inherited, one, from the United Kingdom, and two, from Kenya? What is the difference between estate taxes and, okay, so that's part of the second question. Let's answer this one first.
So the first question, I would say of course that's a bit technical question. We'd have to look more into it. I couldn't give you the answer off the top of my head for that, because I don't want to give you something that's factually incorrect. The honest answer is we don't really get that many cases of dual citizenship, so I'd have to look into it because it's a slightly unusual scenario or slightly more specific to your particular set of circumstances.
So may I request the person who's asked this question of dual nationalities and inheritance tax to actually connect with Mr. Dipesh Shah with the details he's given us, and maybe he'll be able to entertain that question with some research backed up with it. So please feel free to get in touch with him, and I'm sure he'll be able to help us through with that. Now, the second part of that question was, what is the difference between estate taxes and inheritance taxes?
So I think a long time ago they used to be called estate taxes. Now the name is inheritance tax. Maybe just a change of what they've been called. Essentially, it's a tax when you pass away on the value of your estate, and that's going to be an inheritance tax that's payable.
Great, thank you for sharing that. There's several questions that have come up on the chat box while we were entertaining questions that had previously come. Very quickly, I'll take just two of them. Is a gift of £250, can it be given to grandchildren every month?
It's £250 per annum per person.
Okay, I hope that gentleman...
But if you want to give away, sorry to interrupt you there, Dr. Lalitbhai. If you want to give away £250 every month, i.e. you've got £3,000 surplus income, then you could use up your £3,000 surplus income. Or if you're just giving this money to your grandchildren, but not to your children, you could use up your £3,000 annual gift allowance. So yes, you do have options, but not in the £250 small gifts, but you could use up the other allowances. But the key thing is to be careful is that you don't mix the £250 and the £3,000, because that creates that has different rules to follow.
Great. Last question I'm going to take from the chat box, because then we have to move on to our next section of the Minla Zoom session. And the last question is, if you have two properties, can you put both in trust?
So there are limits to the value of assets that you can put into a discretionary trust. So the values that you can put into a discretionary trust without triggering the chargeable lifetime transfer. So if you put in more than £650,000 of net assets, i.e. after the mortgage, then let's say you put in the value of the two properties is £750,000 after mortgages, then you'll have to pay 20% straight away. That's called chargeable lifetime transfer. So that would be £20,000. If the value of the properties are under 600, including the mortgage, is under £650,000, then there won't be any inheritance tax going into the trust.
Brilliant. Ladies and gentlemen, a big round of applause for Mr. Dipesh Shah. All that information came straight out of his head. Thank you very much for that. You've been an absolute legend in answering those questions. And I also encourage Dipesh, if you may share your slide again with your contact details. Mr. Dipesh Shah is very easily accessible via a telephone number and also an email. There we go, ladies and gentlemen, once again getting an opportunity to take a quick photo of this slide. Keep these details with you. Get connected with Mr. Dipesh Shah, a very helpful gentleman and a very friendly person too, and I'm sure you'll get your advice worthwhile. Ladies and gentlemen, thank you very much. Mr. Dipesh, if you want to stop the screen share, that would be great. We move on to our next section of the Minla Zoom session, which is a rapid fire round. With every guest that comes on our show, we play a little rapid fire round for fun, for entertainment. So are we ready, Mr. Dipesh Shah, for this particular rapid fire round?
Yes, 100% ready for it.
Great. So this is, I urge you, it's a very short question, probably a one word, and we would appreciate if it is a one word or a very short answer. We have about 14 or 15 short questions. We'd like to finish them in literally 2 to 3 minutes. Is that okay?
Fire away.
Perfect. So, welcome to the Minla Zoom session with Mr. Dipesh Shah on inheritance tax, inherently unfair. Okay, number one, financial planning.
Financial planning, very important to plan ahead and review.
Pensions.
Pensions form part of your long-term planning, very powerful tax planning strategy.
The ISAs, ISA.
ISAs, go for the investment ones. Cash ones, you may have hold some liquidity in a cash ISA.
Wills and estate planning.
Very important to ensure that you've got your wills are reviewed and up to date.
How frequently would you recommend to review a will?
Every 5 years.
Social media.
Social media, good if you know what you're doing.
COVID-19 pandemic.
Disaster, really bad, really sad. Of course, a lot of people have been impacted in many ways. I would say just make sure your planning is done as best as you can, because everything is uncertain.
COVID-19 vaccine, yes or no?
100% yes. I haven't had it yet, not yet.
But 100% yes.
100% yes.
Okay. Rishi Sunak, the Chancellor of Exchequer.
Doing a fantastic job in very difficult circumstances.
What age should one start planning on inheritance tax?
Straight away. There's no benefit in delay. The longer you leave it, the harder it gets.
Dipesh, the top 3 things that the COVID-19 pandemic has taught you personally.
Life is short. Don't take things for granted. Make sure you do the things that you want to do and plan things ahead.
The best financial institute to study what you have studied.
So I've done various qualifications. I would say it's the CII, the Chartered Insurance Institute.
Thank you. Cryptocurrency.
Avoid unless you've got money that you're happy to lose.
Brexit.
Brexit, who knows? We'll have to wait and see the full impact of Brexit, which we will see in the future.
Last but not the least, I'm going to ask you top 3 tips to save inheritance tax.
Plan, review, and take action.
And the last question here, Dr. Lalit Soda's rapid fire round.
Very good. I really enjoyed that.
Thank you very much. Dipesh, Mr. Dipesh Shah, thank you very much for participating with us on the Minla Zoom session. I am so thrilled to say there has been such engagement on the chat box. Audience have absolutely enjoyed it. There's a question that has come up. Can we see this presentation again? Absolutely. It is live on Facebook. Join on to Mr. Dipesh Shah's Facebook page. Join on to Mrs. Meena Khagram's Facebook page. Join on to the Lohana Community United Kingdom Facebook page. Join on to my Facebook page, Lalit Soda. These are streamed live and they may have also been shared with other people. This was super awesome information that we got on inheritance tax, Mr. Dipesh Shah. We thank you from Minla. However, I would actually like the Lohana Community United Kingdom Secretary, Mr. Bharat Soda, who in conjunction with Mr. Sunil Majitya, the President, are working very, very hard to make sure community at large and specifically Lohana community to gain the benefits of such different information sessions. So may I request Mr. Bharat Soda to come in and say a few words of vote of thanks to our guest speaker, Mr. Dipesh Shah. Bharat Soda.
Thank you, Lalit. Thank you, Dipesh. Well, on behalf of the Lohana community of United Kingdom, Dipesh, thank you very much for today's presentation. I think there's a lot of thought-provoking ideas and information that you've come out with. But two things that really stand out is for everyone, I guess, especially when, when property values in the UK, especially in London, are so high, this impacts most of us. And the two things that stand out to me are, first, have a will, make sure that your assets get distributed the way you want it. And secondly, estate planning. You don't want to, you want to minimize the tax and make sure that your beneficiaries get what you want them to get. So two things, work on it straight away. Do not wait. Let's do it now. Thank you once again. Thank you, Dipesh. Thank you, Lalit. And thank you, Minaben. And thank you, Ali. Thank you very much.
Thank you very much, Bharat Soda, as the Secretary for Lohana Community, United Kingdom. We are very deeply thankful on behalf of Minla to the LCUK. Now, formally, the session doesn't end till our super awesome lady, Meenaben Kagram, who is now currently in Nairobi at the moment, doesn't end the session. So Meenaben, may I request you to join in and give a vote of thanks and end the session here.
Thank you very much, Lalit. This is my pleasant and humble duty to end this session with the heartiest thank you. First of all, my friend, Indu Bentike. I'm very thankful to her who suggested your name and who found you, Dipesh Bhai. I don't know how. My intelligent friends who contributed questions, thank you so much before the hand from all over the world. Our great supporter, Lohana Majan, UK, Sunil Bhai and Bharat Bhai. Our great speaker, Dipesh Shah. We are friends, huh? And Asante Sana to all viewers on Facebook Live and those who have joined us on Zoom. The recording will be with me as well. You can also, I'll put it on the chat on Facebook, and you can always save it for your future use. Can't end up my session without saying thank you to my cute cousin, Dr. Lalit Soda. Thank you all. And we'll now unmute everybody so they can all thank you. Dipesh Bhai. Okay, Ramesh.
Before you unmute Meenaben, can we have Ali on the screen? Ali has been doing a wonderful
job. Ali, you can...
Ali, can you bring yourself onto the screen, please?
Here.
Ali has been in Nakuru. Meenaben, due to reasons, had to move on to Nairobi for this few days. So Ali has managed a wonderful job from Nakuru hosting for this session. Ali, we thank you deeply from our bottom of our heart.
Spotlight yourself, Ali.
There we go, Ali.
Well done. Well done. Very proud of you,
yeah.
Ali. That was really fantastic.
Dipesh Shah, thank you very much. And we are truly and humbled with your presence today, with all the information that you've shared. Ladies and gentlemen, make sure you contact him. Make sure you join us on our future Minla Zoom sessions that are upcoming with some super awesome celebrities over the next 3 Saturdays. We generally do 2 sessions a month, but due to high demand in speakers we have had, we are introducing 3 this month. So ladies and gentlemen, wait for a beautiful lady, a spiritual lady from the ashram of Rishikesh, the Paramaniketan ashram. We have Sadhvi Bhagwati ji, who came with us last year, and she is our wonderful guest speaker coming up next week, and we shall certainly be sending out posters for that. Thank you very much, ladies and gentlemen. Have a pleasant evening. A goodbye from Minla.
Just a minute, I have forgotten to say thank you to Robert Kimani, who had all set up in Nairobi for me. He's a Toastmaster friend of mine, a young boy, and he's always hosting. Thank you.
Thank you, Robert.
Thank you, Robert. We are really grateful for spending so much time yesterday with me for 3 hours.
Robert, thank you. We sent a message on the chat box. Once again, if you can spotlight yourself while we unmute everybody. Robert, can you video spotlight